This video will provide a walkthrough to the solution for exercise 412, focusing on sales with right of return. Here's the data for our problem. Eames Furniture sells high-quality roll-top desks. The company allows customers to return products for a full refund within 90 days of purchase. The desks sell for $3,000 and cost the company $2,000 to manufacture. The company expects that any returned desks can be resold for a profit. And the company has reviewed its historical financial data and determined that 0.5% of all desks are returned for a refund. During the month of January, the company sold 800 desks. We have two requirements for this problem. Requirement A asks us to prepare all the required journal entries to record the January sales. And in requirement B, we're to assume that one desk was actually returned by the end of January, and to prepare the entry required to record the return, and then to describe the appropriate accounting treatment of any further returns. So let's begin with the sales entries for requirement A. One of the easiest items in a sales entry is to record cash. In this case, we're going to debit cash for 800 units times the selling price of $3,000 for a total of $2.4 million. Then, in any normal sales entry, we would next credit sales revenue for the same amount as the cash or accounts receivable. However, in this case, because of the 0.5% estimated returns, we're only going to record 99.5% of the sales revenue. So 800 units times the selling price of $3,000 times 99.5% is a credit of $2,388,000. The balancing amount for the journal entry is $12,000, which will be credited to a refund liability account. And that calculation can be confirmed as 800 units times the selling price of $3,000 times the estimated 0.5% return rate. Now we have to record the associated cost of goods sold. So we're going to debit cost of goods sold for 800 units times the cost of $2,000. However, we're also going to multiply this by the 99.5%, which is a total debit of $1,592,000. I'll leave a space here. And as part of any normal cost of goods sold entry, we're going to have to credit inventory for the units that are sold. So 800 units times the cost of goods sold of $2,000 is $1.6 million. For this journal entry to balance, we're missing a debit of $8,000, which is going to go to a refund asset account. And the equivalent calculation for that is 800 units times $2,000 times the 0.5% estimated returns rate. So in this entry, the company needs to make an estimate at the time of sale of the amount of returns that are expected, and then exclude that amount from the reported revenue, and instead report it as a refund liability to reflect the fact that if the product is returned, the company must return funds to the customer. At the same time, the company reports an asset equal to the expected amount of the product to be returned based on its cost. Now for requirement B, the first part of which is to record the entry for the return of one desk. What we're going to do is debit the refund liability for one unit times its selling price of $3,000. We're going to debit inventory to bring one unit back into inventory at its cost of goods of $2,000. We're going to credit cash for the $3,000 to return the funds to the customer. And the remaining $2,000 credit is going to go against the refund asset. So in essence, what has happened here is that the refund liability has been reduced by one unit, and the refund asset has also been reduced by one unit. For the second part of requirement B, we're asked to describe the appropriate accounting treatment of any further returns. So at the time of sale, it was estimated that 4 desks would be returned during the refund period. That's based on 800 units sold times the 0.5% return rate. If a further 3 desks are returned before the period ends, the journal entries would be exactly the same as the one we just did. If the refund period expires and the number of desks returned is different from the original estimate, the refund asset and liability account will need to be adjusted through net income. Basically, the balance in each account will have to be eliminated. As a practical matter, the company will likely continue to review the balances of the refund asset and liability accounts as part of the normal year-end adjustment process. And that's it. We've solved this problem.